The board hosts a virtual town hall to present the 2022-2023 budget, propose changes to the construction rules, and propose changes to the community rules. The board revisits the policy governing dogs on the beach over the summer season, and a look back at the 2017 rental tax proposition and what impact, if any, it would have had on the community. My name is Greg Pichler of the MXB Wire, on location at the Bethesda studio, and you're watching my monthly update for Wednesday, March 16, 2022. On the virtual town hall, Jerry Kafka, the acting treasurer, presented the fiscal year end 2023 budget. The assessment will increase from $2,750 to $3,075, representing a $325 increase, or roughly 11.8%. Kafka reported that the acquisition of the new Polaris will reduce maintenance costs going forward. Kafka also reported that increased volunteerism by members of the community saved the association in excess of $30,000 in salaries and taxes that would have otherwise gone to contract labor. The increase in the assessment, however, $325, is largely attributed to the hike in the cost of line item drainage. That is line item number 05703. The line item in the budget went from $16,000 in fiscal year end 2022 to $100,000 in fiscal year end 2023. However, the community spent in excess of $78,000 in this line item over the course of the last fiscal year. The budget routinely aligns with the members who sit on the board of directors. This budget is no different. In the case of this board, the members are largely Pineside residents and not Oceanside residents. Likewise, the budget favors the Pineside residents to the detriment of the Oceanside residents. What do I mean by this? Well, the line item drainage is at $100,000. That is $400 a property. I don't have a problem with that because we have an ocean side, we have a pine side, 2/3 of the residents live on the pine side, 1/3 are on the ocean side. But when I hear people complain about the assessment of Middlesex Beach, particularly from Pineside residents, I stop to think, where would they be relative to other homeowners associations? Ocean Breezes, which they compare Middlesex Beach to, doesn't have drainage issues. They don't really have a Pineside the way we do. Pineside drainage issues are costing us $400 per property. So you can't compare apples to oranges when you look at our assessment. For Pineside residents, they're really getting a bargain. They're getting 1/3 of the community subsidizing their drainage issues. I'd also like to mention that it's commendable to see the level of volunteerism in the community that saved the community in excess of $30,000 in lieu of labor expenses and taxes. However, it cannot be understated that when Dave Weeking was on the board, he saved the association over $30,000 per year due to his service. Dave was the equivalent of a full-time employee. The effort level put forward by Jerry Kafka on the budget, as well as in the investigative analysis of the internet service options available to the community, is also quite commendable. Association President Paul Bradley reported that the board plans to vote on the policy governing dogs on the beach over the summer during the board meeting currently scheduled for Thursday, March 17, 2022. Bradley further reported that on a recent survey on the topic, that 82 members voted to keep the policy as is, while 74 members voted to relax the policy, allowing dogs on the beach from 10 p.m. to 8 a.m. the next morning. After open discussion regarding the health and safety issue that surrounds barefooted children in proximity to dogs, a number of members on the call asked to change their vote from being in favor of relaxing the policy governing dogs to retaining the policy as is. Ultimately, it's not going to be the survey that determines the policy, but rather the vote on the motion at the meeting currently scheduled for Thursday, March 17, 2022. In fact, the board had addressed the policy governing dogs on the beach over the summer season over the course of a board meeting on Saturday, October 19, 2019, 2.5 years earlier. 5 members of the board voted in favor of the motion to effectively retain the long-standing policy governing dogs on the beach, including Steve Larson, Jeff Sella, Alex Sella, Ellen Troop, and Nancy Glasgow, while 3 members opposed the motion and relaxed the policy regarding dogs on the beach, including Marty Schechter, Mike O'Mara, and Tristan Kruger. Then President Margie Sear abstained. In fact, on Saturday, October 19, 2019, Marty Schechter spearheaded the motion to change the policy governing dogs on the beach over the summer season. Clearly, now that Schechter acolyte Nancy Glasgow, who on October 19, 2019, voted against relaxing the policy governing dogs on the beach against Schechter's wishes, is off the board, replaced by Nora Alter, Schechter is again spearheading the challenge to the policy governing dogs on the beach. However, as he is no longer on the board, this time Schechter is acting through one of his acolytes. Schechter's acolytes include Nora Alter, Amy Sandover Whitcover, and Ron Thomas. These are the people Schechter reportedly directs how to vote on important issues. Schechter has a history of revisiting issues at a subsequent board meeting, even when the same motion has been recently defeated only a few months prior. For example, Schechter brought a motion before the board to purchase a second Moby bat multiple times over the course of multiple board meetings in 2020. Since his initial entry onto the board in September 2018, Schechter has had 3 principal motivations for being on that board. Firstly, Schechter wants to walk his dog on the beach over the summer season. The health and safety of children be damned. Secondly, Schechter wants to grant favors to his close friends in the community by authorizing projects, some to the detriment of association assets. Thirdly, through the implementation of an 8% rental tax, Schechter wants someone else, namely the vacation rental property owners, to underwrite his utility at the beach. Even when Schechter was presented with a legal opinion on 2 separate occasions that his rental tax proposition had no legal merit, Schechter doubled down. Schechter attempted to bring a motion before the board by which the community would put the matter to a vote in the guise of a covenant change. Schechter had help. Both Steve Larson and Nancy Glasgow voted to implement a rental fee structure in the guise of a board-sponsored covenant change. Neither Marty Schechter, nor Nancy Glasgow, nor Steve Larson have ever wavered on enacting a covenant change to require vacation rental property owners to pay a fee in exchange for no material service in return. They have each explicitly stated that their primary motivation is to reduce their contribution to the expense of operating an association, loading up the vacation rental property owners with a proportionally greater share of the burden. If you are a vacation rental property owner, they simply want to claw off your revenue. It has been 5 years since Nancy Glasgow, Marty Schechter, and Steve Larson filed what became known as the 2017 rental tax proposition. The 2017 rental tax proposition was in fact a petition bearing the signatures of members of the community reportedly representing 30 properties in Middlesex Beach. The 2017 rental tax proposition demanded the board charge no less than 6% and no more than 8% on gross rental revenue. The proposition did not stipulate what services, if any, would be rendered in exchange for the tax collected. As the provision does not explicitly state any services being rendered in exchange, the tax would in effect be levied in exchange for nothing in return. The monies collected would in turn lower the assessment in proportion. Now, to illustrate the impact the 2017 rental tax proposition were to have on the community, I've taken the liberty of putting together a spreadsheet of the impact it would have on my property, the vacation rental property at 20 Dune Road, as well as extrapolating the tax revenue collected for the entire community and what impact that would have. So I've illustrated the effect in 5 separate years moving forward from 2017. Had the 2017 rental tax proposition gone into effect, it would have affected 2018 through 2022. So I've broken those figures down for those 5 years. So here at the top of the spreadsheet, there's 2018, then 2019, 2020, 2021, and finally this current year based on forecasts and what rental reservations I've already taken, I've come up with some 2022 figures. So first thing I'd like to start is going back to 2018. I earned in gross revenues $90,500, and I raised my rate from the year prior $250. So there was a 4% increase in rental rates. And what I did is based on my own experience, I tried to extrapolate that to the entire community of vacation rental properties, all 48 of them. So even with my models, I came out with a total tax revenue collected of $215,000. Well, what impact would that have had? Well, in my particular property, my tax expense would have been $7,240 here. And the assessment over here that was collected by the community, in 2018, the assessment was $2,250. So when the community collects $215,000 from the community of vacation rental property owners, the assessment then goes down from $2,250 to $1,354. So there's a savings of $895. Well, together, I owe the community, if the 2017 rental tax proposition were to go in effect, 2018, I would have owed not $2,250, but I would have owed $8,594. So the difference is $6,344. Now, moving on to 2019, I raised my rate from $6,250 to $7,000. When I did that, I actually made less money. I went from $90,500 to $75,548. So you can see that just because you raise your rate doesn't mean you're going to make more income. There is a market value of your property, and in 2019 I had 1 or 2 weeks where the property was not occupied, so I actually made less money. Now, even with that $75,000 of gross revenue, on 8% rental tax, I would have owed $6,043.84. The assessment was $2,350, so there was only a nominal increase in the assessment. So I extrapolated based on how I raised my rate. I raised it 12%. I added 12% to the tax revenue collected in 2019 on my model. So now it went from $215,000 to $240,800. That means that under that provision, it would bring the assessment down from $2,350 to $1,346.67. So that's a savings of $1,003 for every resident in the community. So when I add the taxes I owe plus the adjusted assessment, I get a total payout to the community of $7,390. Does that sound like a lot? It is a lot. It's a lot of money to be handing over the community in exchange for nothing in return. So in 2018, I would have paid $8,594. I would have gotten no additional services than what I got without the provision at $2,250. And the following year, I would have paid out $7,390. And again, in exchange for nothing, where without the tax provision, the rental tax provision, I only had to pay $2,350. Now, moving on to 2020, this was the pandemic year. I actually made more money, but I dropped my rate because of all the uncertainty. I dropped my rate from $7,000 to an average of $5,600 over the course of the summer weeks. And so I made more money largely due to the fact that people were working from home, they were working remotely, and kids were learning remotely. So the season really didn't end. Seasons typically end at Labor Day when kids go back into school, but the season went well into November. So I made considerably more money, almost as much money as I made in 2018. But 2020 was not the disaster I was thinking it would be when the pandemic hit. So given that with the 2017 rental tax proposition, I would owe $7,144. The assessment without the rental tax proposition, the assessment was $2,450. So again, a very nominal increase from the year before. What I have here is the amount of tax revenue collected by the community drops from $240,000 to $192,000. And that means that the adjusted assessment goes from $2,450 to $1,600 and $1,647. So that's a savings of $802 for the community. But when you combine the taxes I owe, which is $7,144, plus the adjusted assessment, I now owe the community $8,791. Again, I'm paying $8,791 for the basket of services I would otherwise get with the assessment of $2,450. So that's a difference of $6,341 in exchange for nothing in return. Now, moving on to 2021, I had a huge year after the pandemic. You may remember that the lockdowns are largely still in effect. People are working remotely from home. Many counties still have children learning from home. They're not even open. So the constraints of the summer season are not limited. And I raised my rate from $5,600 in 2020 to $8,750. And I made more money and I had more bookings. So I owe a huge amount of money to the 2017 rental tax proposition. So 8% of that is $10,172. The assessment in 2021 was $2,750. So that was a fairly large hike from the year before. So I have the community being able to collect, hypothetically, being able to collect tax revenues of $301,000. That's on a huge hike of rates. So I'm assuming I'm no different than any other vacation rental property owner. We're all raising our rates. We're all getting more revenue. So the taxes collected by the community jump from $192,000 to $301,000. And that means the adjusted assessment goes from $2,750 to $1,495. That's a huge savings. That's a savings of $1,254. Everyone receives that savings, but I'm paying $10,172 plus the adjusted assessment for a total to the community of $11,667. $11,667. Just contemplate that a moment of you writing a check for $11,667 to the community for 1 year and not getting any more basket of goods than you got when you paid $2,750. So let's move on to 2022. Well, I've already taken reservations on the books that amount to $99,000 and $99,450. I reduced my rate from $8,750 to $8,400. So there was a minus 4% increase in rate. It's actually a 4% decrease. So it's minus 4% increase. That means the community, the taxes collected so far, would drop from $301,000 to $288. Now the season isn't over; it's just starting. I'm probably going to see this figure, $99,000, go up to $120,000, $130,000. But if things were to stop today, that's what tax revenue the community could collect under the 2017 rental tax provision. So the assessment is now $3,075. If the season were to stop today and I fulfilled my rental obligations, I would owe the community $7,956 for the tax expense, and the adjusted assessment would go down from $3,075 to $1,871. So the two together mean that I owe the community $9,827. $9,827. So in total, over the past 5 years, I would have written checks for $56,000, in excess of $56,000. That averages to over $10,000 a year. What I paid was $12,875, but I would have owed $56,000 on Nancy Glasgow's great idea. That means that in addition, the difference between what Nancy Glasgow would have me pay and what I legally pay, what I legally owe, which is $12,875, I'm overpaying by $33,000 and $395. $33,395. $33,395 over the span of 5 years. So was it worth hiring Dean Campbell for an hour to give me a legal opinion on the legality of charging a 8% rental tax? Yeah. I saved $33,000 over the last 5 years from people who want to claw off revenue off my property without legal merit.